So I try not to read minds, but I did read a lot of literature and look at the numbers for what they were doing. And if you look back before the pandemic, there was a BlackRock paper with actually some former Fed officials advising it too, and they talked about how, and this was something I was covering at the time, which is why I was looking at papers like this, which is that when you're already practically at the zero bound and you run into a recession, and you have this much debt in the system, what do policymakers do? And so back then, that was back when there was $18 trillion in negative nominal yielding bonds. Inflation, all that magazine headlines were like, inflation's dead. How could we ever possibly have inflation? And I wrote at the time that central banks and fiscal policymakers can generate inflation if they really, print a crazy amount of money and just give it to people. Or corporations for that matter, to print money, give it to small businesses, give it to large businesses, whatever they want to do. And so I was kind of looking at literature and see what policymakers were thinking. And one of the things that BlackRock paper covered was, probably the next steps were going to be, okay, you go into recession, you cut rates to zero, that's not enough, so you do very large fiscal stimulus, but that could be inflationary, and if you try to raise rates, you kind of counter this fiscal stimulus you just did, and so you have to basically hold rates low and let inflation run hot for a period of time to kind of restart things. And it's funny because that's kind of the step-by-step playbook for what they did, except everything was dialed up to 10 because it was not just a recession, it was a pandemic and lockdowns and madness. And so that's kind of the playbook they were going with, where the Fed even said, we're not even thinking about raising rates. We're going to have an average inflation targeting, meaning we're, because their official inflation metrics ran below their level, they were comfortable letting them run higher their level. I think where they pivoted was and Jay Powell talked about this in Congress before inflation came. Congressman asked him, they said, what do you think about the recent 25% year-over-year money supply growth rate? That was back then. That was back in 2021. And he basically said that, from their models, monetary aggregates are not very important for the economy. They have to unlearn the importance of monetary aggregates. And I think that's just a wrong model. I think they underestimated the importance of broad money supply. It was very different than the actions of 2008 because the fiscal portion was much larger and more direct. It's not just bank reserves being recapitalized this time. It was actually the people and businesses being recapitalized, basically money going out to them, increasing their spendable money into the economy. And so I think the inflation wave hit harder and faster than they thought. And then it became the number one political issue. If you looked at polls at the time, inflation was the biggest thing. And so the Fed had to basically understand that the models were wrong. And that as much as they would have liked to have let inflation run hot for a period of time, it became so hot so quickly that they had to change into it. And, I think the second mistake then was trying to do everything right away. Basically, instead of just accepting this mistake now and you can fix it over time, it was like, let's turn on a dime and go from 0 to 5% rates, which when you have that much debt in the system and you're coming off of that low of a level, you're going to break a lot of things. And instead of letting that policy kind of take its time to go through the economy, allowing refinancings to happen over time, they kind of just rammed it all through at once. And I think we're probably still going to be dealing with those side effects for quite a while. I don't think we're done dealing with the side effects. And I think the final point I'll make there is that when you hear Jay Powell talk, he's mostly referring to the 1970s. He's referring to Paul Volcker. He's comparing himself to Paul Volcker, essentially. And I think the challenge is that the inflation dynamics we're seeing today and recently are more like the 1940s, which is that, in the 1970s, inflation really had two big components. One was obviously the supply side, like oil limitations, right? So domestic oil production in the United States peaked in 1970, and after 100 years of going up, it rolled over conventional oil production, and so it became more reliant on imports, and therefore we had all those geopolitical challenges and supply shocks and things like that. But number two, you had a demographic surge. The baby boomers were entering their home buying years, and so you had a lot of lending-driven money supply growth. That was basically the peak period of U.S. domestic bank lending. So you did have some money creation from fiscal stimulus, basically the guns and butter policy, but the majority of money creation was coming from banks, and therefore the act of, one, fixing the supply side through geopolitical means, and two, trying to tighten monetary policy did do a lot to quell inflation. Whereas 1940s, we had just as high inflation. Actually the year-over-year figure was higher in the 1940s, but the average for the decade was around the same. And the difference was the banks were not lending back then. That was not from excessive bank lending. Money creation was not coming from banks. It was coming from very large monetized fiscal stimulus, which was obviously war-related, but a lot of that war-related spending was domestic. You were building manufacturing facilities. You were getting commodities. When the GIs came home, there was the GI Bill that sent 8 million of them to college and technical school, and then subsidized their mortgages. Basically, that's a domestic stimulus, a fiscal stimulus. And so you had this huge money supply growth, monetized by the central bank and the broader banking system. And so, very big surge in broad money, quite inflationary, and rates don't really affect that. Like rising rates doesn't really affect how much the government's going to spend. And if anything, it actually makes them have larger deficits because they're paying higher interest on their debts, and that's adding to the deficit and actually contributing to money supply growth as you take money supply growth out from elsewhere. And so I think basically the dynamic we're facing now is that inflation is going to be a rolling concern as long as fiscal deficits are very, very large, and as long as we have some supply constraints on the commodity side. Now, that doesn't mean we have inflation every year. In the 1940s and 1970s, inflation came in waves. So you'd go up really high, then you'd have a disinflationary period, and then you'd have another spike in inflation. And it's because central banks and policymakers did fight back for periods of time, especially in the 70s. You had price and wage controls. You had central banks trying to tighten. In the 40s, you didn't really have the central bank fighting back, but you still had things like wage controls and rationing and things like that. There were attempts to try to, address the demand side to try to quell prices, and we're seeing that somewhat now. But I think the thing that's a risk going forward, and that not enough people are talking about, is that even though we have this recent inflation wave under control, there's a risk of future waves of inflation because those underlying dynamics are not addressed, which are the commodity supply side and the ongoing fiscal deficits. So the short answer is yes, but it's more nuanced than that. And so you generally see a lot of these headlines like, death of the dollar de-dollarization,
right.
Things like that. On the other hand, you see a lot of people saying nothing's going to change. This is a nothing burger. That's doom. That's like doomsaying, and nothing's going to change. And I think the extremes tend to be wrong, but I think we are seeing a trend change. I actually wrote an article back in 2020 called "The Fraying of the U.S. Reserve System," which was basically analyzing some of the costs of the system, how the system's changed over time, and how the world's likely to trend towards a more multipolar direction, which is to say that it's not another country's currency that's going to come and take over, right? So we're not going to all be using yuan in 10 years. But it is to say instead that the world is likely headed in a more multipolar direction. And if we step back a little bit, this is somewhat inevitable because the system that's been in place is in many ways unnatural, and things that are unnatural are kind of hard to maintain. And so after World War II, the United States was basically king of the world, right? Our homeland was mostly untouched by the war. We had huge trade surplus. We had a huge positive net international investment position. We had an intact manufacturing base. We had tons of gold. Other countries even shipped their gold to us for custody, for safekeeping during the war. We had, unrivaled military strength, economic size, and so we had over 40% of global GDP. And so we basically could make all the rules, and we could become the new ledger and take over from Britain. And that obviously was a kind of a multi-step phase.